While we're waiting for our last panelist to join, I just thought I'd start off by welcoming all of you to this session on financing next generation companies. Thank you for being here, and I understand that many of you are entrepreneurs and representatives of companies yourselves. Can I just have a show of hands of anyone who's here from the corporate side? Fantastic. So, the purpose of this session is really we had a session yesterday where we heard from some of the growth companies as to their constraints in terms of finding the funding and the support for their continued growth. And I'll just, for the sake of my panelist colleagues, I'll just repeat them as quotes. You can take them with a grain of salt. But essentially, the view coming up from the growth companies in a nutshell was, PE firms are expensive. The state banks don't really know what they're doing. They're patient, but they don't really know what they're doing. And the private sector banks are just selling the product of the moment. They're here to pitch a product and they go away. So what we're looking for in our partners is somebody who can be with us for the long run, who can serve our needs as we evolve, and who can help us understand how to deal with the environment of tomorrow. Not just the environment of today, but the environment of tomorrow. So the purpose of this session is to get these gentlemen to offer their perspectives on the challenges they, as representatives of financial institutions, they face in serving the needs of the companies of tomorrow. And the opportunity for serving the companies of tomorrow is an immense one. In India alone, if you look at the year 2000, there were roughly 26 billion dollar companies in the year 2000. In the year 2010, there were 146. So you had a five-fold increase, nearly five-fold increase in the number of billion-dollar companies in this period of 10 years. If you look ahead to 2020, even relatively bottom-end estimates suggest that there'll be probably 400 such billion-dollar companies. Also, we shouldn't forget the market for companies that are smaller than $1 billion. That's also huge, and it's growing at unprecedented rates. So in terms of demand, in terms of opportunity, it's one of the most interesting and vibrant parts of the economy. It's extremely important to the economy, for the growth of the economy. It's important for employment, job creation, and so on. So with that, while we wait for our last panelist to join us, I would say that we actually have a fantastic representation. We have a regulator. We have somebody from the preeminent state bank. We have somebody from a global investment bank. We have a representative of the private equity industry. We have somebody from a stock exchange, and also from a private sector bank. We're also lucky that we have a perspective that extends beyond India. Mr. Muhammad Ali is here from Pakistan. And perhaps I'd like to start by just requesting each of these gentlemen to provide a brief perspective on what they see as the challenge in serving the global growth companies. Perhaps I can start with you, Mr. Chaudhuri.
Thank you. Thank you very much. I think this is a very good idea, and State Bank of India really prides itself of having supported some of the big companies today, as you mentioned, $1 billion companies, at a time when there are not much support available for them. So basically, we have found it to be a good experience that the companies who start from very small beginnings grow up to become big. But today, even we are subjected to a lot of scrutiny by the investment community, be it the analysts and be it the others, regarding the size of and the quality of our portfolio. So there is a huge difference in perception of a debt analyst and an equity analyst. And on one hand, we have to satisfy the equity analyst perspective by supporting these companies. We also have to keep in mind what the debt analyst would be saying to that. So that's a fine challenge we are always trying to tread. But basically, I think in order to have long-term viability, you must have assured raw material source and think global, that you should position yourself in such a way that either by way of raw materials, either by way of imports, either by way of services, the people and the personnel, you have a competitive advantage, not only in India, but globally. So I will limit my initial comments to this and maybe come back on other issues.
Perfect. Ashish, perhaps we can turn to you for your perspective as a global investment bank.
Sure. I mean, I echo what Mr. Chaudhuri said here. I think from our perspective, obviously, UBS is a global investment bank. I think we've funded and a lot of our Swiss multinationals as they've gone across the globe. But, and I think going forward, I see a gap increasing in some of the, in funding for growth companies or funding for societal important companies, especially in the place of like IT or BPOs or renewable energy and stuff like that. I think you're going to start seeing a gap, and it's going to become increasingly tough for certainly global banks, certainly I can talk for the big multinational global banks, to start funding some of the stuff because of just the capital, the regulatory capital regimes that's going to come in under Basel III. A lot of these companies have great aspirations, great plans, but when it comes to, at the end of the day, it comes to funding them, besides the plans, they really have no hard assets. And that becomes a huge issue, both from a capital perspective as well as from a funding perspective. So I think there will be opportunities, whether it's for PE funds or some other quasi-banking companies to move into that space, and that is an area that either a big bank like us could look at doing something in, but there's something that clearly is a gap that will need to be closed going forward. I'll just leave it with that.
Perfect. Actually, and I'll give Mr. Kapoor a chance to settle in, but maybe we can pick up on some of the points you raised in terms of the difficulty for Western banks and multinational banks, and particularly investment banks, from a capital charge and profitability perspective to support these businesses. So I'll come back to you and say, and ask you if that means that they should actually look elsewhere, but we'll hold that for a second. Manish, you have obviously wide experience of investing in companies. What do you bring to the table? How do you think about the opportunity?
I just keep my thoughts limited to a couple of ideas, which we can expand as the conversation goes on. But I think, one, I will bring purely an equity perspective. The many more people in this room which are far more qualified to talk about the debt side, probably on the equity side also, but I'll keep it to the equity side. I think the two or three themes I want to touch on. One, it's way beyond the deal. It's not just the private equity guys, but it's also the companies that PE invests in get so stuck on the deal, and particularly on valuation, that you sometimes make a suboptimal choice on who your partner is. Because I think what we want to bring to the table is a significantly different way of funding companies with equity. One which looks on us as the owners and long-term partners, and really has a longer-term perspective than what one traditionally would give to PE. We'd also only want to get involved if normally joining a board is a CP, a conditional precedent that you negotiate. We would only want to do it if the companies really want one of our operating partners, and I'll talk about it, on their boards. The only other thing I want to touch upon at this stage is when we talk about next-gen companies, the mind immediately goes to young, emerging companies, more VC-like, venture capital-like. But I must say, if you look at companies in India, given the opportunities that you see in terms of growth domestically that they can leverage off, or take some of the models that they've built, the low-cost model, the bottom of the pyramid ideas, and take it across global markets. So in my mind, when I think of next-gen, it's not only, of course, they're what I would call the emerging leaders, young companies, sub-billion dollar, of course, growing in. But I also think many of the larger companies, even more than $1 billion, I would still consider next gen, because the way they're transforming to take over what is rightfully theirs in the Indian economy, but also take the model that they've adopted here and use it effectively in other markets, I would also consider them next gen. So from that perspective, I don't want to tackle both, and what private equity do to both type of players, both small and large. But it all hinges around the PE player and the company being dovetailed sort of hand in hand, and really providing a ton of long-term value rather than just talking about it.
That's a great point in terms of thinking about what is the nature of the company that you're looking at. The GGC term from the forum's perspective is a good indicator. We're talking about growth companies, but also ones who tend to operate increasingly across border. So obviously there is an opportunity for growth companies who are entirely domestic. There's potentially an even more exciting opportunity to serve those companies moving abroad, who have an added complexity in terms of being able to also have various, not just deal, but operating requirements in the markets that they're moving to. So Kapoor, perhaps you want to talk about your perspective on what it takes to serve, what the opportunity is and what it takes to serve next generation companies.
I can speak for our home country to the extent that India is a basket of growth, that there are opportunities galore for bankers, for financiers, for private equity players, for leading bankers like State Bank of India. In my judgment, the biggest need of the hour is for bankers to transform their risk architecture. Because we, more often than not, don't understand that the risk atmospherics in Indian banking, also in global banking, have changed very dramatically. So the most important thing today is to really understand the risks of the customer and respond to the customer needs in a very diagnostic and in a very prescriptive manner. And I use this parlance in my own bank. I call it that bankers have to become like money doctors. We cannot be into supply-side banking and just like, public utilities giving tons of money without understanding that today every company, small, medium, large, needs an advisor, needs a touch point in relationship management, needs a knowledge connectivity with a bank or a financial institution or a private equity house for that matter. So I think today we need to really redefine banking and look at India, not just next 2-3 years, but 2050, when I hope our per capita income is also like $100,000. So judgmentally, I have a view that bankers, to make this point, should become more and more prescriptive, understand, I call it knowledge banking. Rest of the world, they have industry specialists. I personally believe that every vertical needs experts. So if you're looking at food and agri-business, for example, which is a great growth industry right now, you have to understand that the large companies are multinationals, are very branded companies. They already have an appellation. They have a brand. So when you cascade that to medium-sized companies, dairy companies, horticulture companies, and you move it to the next level and the next level, what is called priority sector lending in banking, very important for all of us here. There you have to create value. A banker today has to run a money clinic. The branch has to be a chopal. A branch has to be, in English parlance, it has to be a town hall. So we must create a branch beyond the banking hours, before and after, and we have plenty of time because we pay rent, like we charge interest round the clock. So we must use the branch, and Mr. Chaudhuri has so many branches, that you can create, knowledge centers out of these branches. So whether it's basic consumer intelligence, whether it's like, conveying the first person who wants to open a bank account, or to build a little business in terms of viability, how to manage a cow farm, how to manage the very basics of what is going to be very inclusive food and agri and therefore responsible for food security, to create the platforms, and bank branches are very underexploited in India. We don't have a problem of branches, believe you me. So we must create them into town halls, into intelligence and knowledge centers. I think this is really the need of the hour. Dovetailed with fantastic, India and the rest of the world has got the huge leapfrogging advantage on ICT. Information, communication, and technology in banking has leapfrogged. So today, you can take at lower cost, you can reach out to far more people, in vernacular included, in demonstration included. So I'm a great believer that we must create vehicles of communication. Communication builds trust and confidence, which is most important in banking. So I can
Actually,
go on.
that might be a very good point to that question of technology. Obviously, the BSE is an important technology-enabled organization, but I'd welcome your thoughts on more broadly what this, from the stock exchange perspectives, what is the opportunity and how do you feel that you can support it?
I think there are several aspects to this. One is what I call this growth industry itself, or growth company itself is a little bit of a sort of difficult thing to sort of define. And for me, there are companies which require huge amount of capital and in some sense don't generate that much of wealth. There are companies which don't require capital and generate huge wealth. And so you have kind of several layers of capital and sort of financing needs all of them may have. But in terms of the exchange perspective from India, what we did is recently we started a new platform called SME platform. Now in India, SME is really tiny. Means we take companies starting from $200,000 onwards. And so in last 6 months, since we started, we have around 11 companies listed. Today, 11th company got listed. And they have come from variety of industries. So, I mean, I'm very hopeful. I mean, we have people from healthcare, we have people from home finance, we have people from advertisements, we have people from all sorts of 11 companies mean 11 industry actually. And many people who did not have chance to come and sort of raise funds from public till say 6 months back, because our our targets were very stringent that you needed to have minimum capital of around $5 million US. Now it has been brought down to $200,000 for the small and medium enterprises, and suddenly you can see sort of rush of people wanting to come in. And one of the reasons is because for me it's wealth creation. It's not about need for finance. That those basically, many of these companies don't require huge amount of finance. Many of them may require. But the concept of creating wealth out of income is kind of gaining grounds. India is becoming more what I call entrepreneurial. And India has almost 3 to 4 crore companies of various sizes, largely small and tiny. And how do we give them a framework from going from staying SME to becoming sort of medium and then going to the large board or main board as we call it. And so we have given a framework for sort of automatic graduation. When you reach so much of capital, you can actually grow up. And again, there was an issue of because they are risk companies, because they are very small, the chance of their going away is very high. So we had to ensure that the small investors don't really come into the market, especially in this side. And so we had to keep a minimum lot size as $2,000 and saying the small guys don't come in, large guys come in, and they participate in these funds and they allow what I call exit for the PEs. They allow many more, even succession planning to family companies, the benchmarking and so on and so forth. And then what we did is we introduced the concept of market maker, where a two-way code is given because these are very small lots. For example, if a company collects around $2 million, they will have probably 1,000 lots totally trading in the market. And how do you give liquidity to that? So we introduced the concept of market maker, and that has been found to be very, very successful. So in some sense, that portion of the market which was not touched by the exchanges, which was basically going to the banks, and in a sense, I think you started with saying banks sort of don't fund the small guys. They require a lot of collateral and a lot of things which today has become, as you said, prescriptive. And I mean, even a normal banker would fund a young guy. Otherwise, today he's not funding because he has to go through all the regulatory checks. And those guys are coming into this market. And for me, the Indian IPO market was what I call fully priced 6 months back, because all the big companies that are coming are basically completely priced. And so you don't have upside, which is multi-bagger. The multi-baggers are going to come from these small guys. And you never know. In fact, I remember Infosys, when it was listed, it was a very small company. And at the price, I think it was 70 rupees, and the issue devolved. Okay? And so
Absolutely.
many of us don't know that some of these guys are going to be tomorrow's Infosys, and that's what my hope is. And I mean, many of entrepreneurs sitting here, I would invite them to come and create wealth on BSc rather than only working for income.
That's a great theme. Mr. Ali, love to get your perspectives as a regulator and potentially from somebody who is less focused only on India.
I think we need to put things in a bit of perspective here, and would like to do that. How businesses have evolved over the last century or 2 centuries. Over the last couple of 100 years, the governments have been investors in various businesses where the gestation period is very high. Trade started by a lot of countries. We saw the shipping, the arms, the medical research, internet itself. So a lot of businesses or sectors which required huge amounts of investment, where the return was very uncertain and the gestation period was very, very large, governments took the brunt. And the private sector entered late, and they shared the benefit and they reaped the rewards with the governments. Now, over the last 2 decades, the changes that we are seeing as compared to what the world was before, the governments did borrow huge amounts of money over the last 50 or 100 years. Now, their borrowing are so high that I don't think we will see governments being able to invest that sort of money that they have done over the last 100 years into businesses and developing the sectors. I don't think that will happen because the borrowings are very high, governments are poor, and secondly, the private sector itself has made a lot of money. The wealth creation in the private sector has been huge, especially in the West that we have seen. Secondly, I think the world has gone through the uncertain era where whether socialism or capitalism, which economic model would prevail. I think the world has decided that it will be a capitalistic society everywhere. Privatization has happened, and a lot of businesses have gone into the private sector. So going forward, I think the private sector will be required to invest in high-risk businesses. In high-risk businesses, already we are talking about alternate energy and e-commerce and biotechnology. These are very high-risk industries where the returns are uncertain. So the financial landscape, the financial sector will have to be ready to take larger amounts of risk, number one, and to fund businesses where the default rate might be on the higher side. I think that's a reality that we will all be living in going forward. Now, as far as the large businesses are concerned, I think they have been able to raise money and they will continue to be able to raise money because the banking sector is very comfortable lending against assets as a collateral, number one. There's a lot of name lending, especially in Asia. Bankers are not, they have not really come up to a level where they can take larger amounts of risk and they can fund business plans. And I think that will remain, that reality will remain because bankers by nature are conservative people. So how do we bridge this gap? The larger companies will get financing, I think, but I think what we need to focus on is the smaller and medium companies. And no matter what industry the future companies, the next generation companies belong to, certain characteristics will be common. Number one, we will see, I think going forward, a lot of first generation entrepreneurs in the future. There'll be lots of small and medium sized organizations. And thirdly, there'll be less of tangible assets and there'll be more of knowledge assets and human assets. So in order to fund these, I think we'll have to focus around developing the capital markets. Now, globally, a lot of small and medium enterprise exchanges have been set up. India has, BSE has done, as Ashish was saying. I think going forward, we need to have marketplace where business plans can be presented to investors. We need to bridge this gap because we will need more risk capital where businessmen, entrepreneurs can come and at least present the plans. What has happened in the past is regulators, in order to fulfill their mandate of investor protection, they have, in some countries, and not some, in a lot of countries, they have shut off investors from seeing those investment opportunities. Investor protection doesn't mean that you don't let investors at least see those business plans. I think we will see going forward, besides the SME exchanges, we will see marketplace where we will have to segregate we'll have to do investor profiling and the business risk profiling, whereby institutional or educated investors can come and they will be able to take exposure on high-risk companies like IT or e-commerce or whatever. Then there'll be another category of investors who will be able to take risk on the medium-risk enterprises and less-risk enterprises. Because the regulators can fulfill their role of investor protection, and at the same time, we will allow businessmen or entrepreneurs to go and at least offer their business plans. I think that's a reality which we will see over the next decade or so, firstly. Secondly, in order to fund future companies, I think there is a need for documentation, especially in our part of the world. We're talking about India, Pakistan, and some of the neighboring countries where there are large undocumented economies. Bankers are uncomfortable lending to businesses which are not in the corporate sector. The corporatization rate is much lower. I mean, if you have 3 or 4 crore businesses in India, I'm not sure of the exact number, but in Pakistan, out of 3 million businesses, only 2% are in the corporate sector. So as regulators and as financial market players, we will have to work in a concerted manner with the governments as far as documentation is concerned, corporatization is concerned, so that the rating agencies will be able to play their role, the credit bureaus will be able to play their role, bankers will be more comfortable lending to businesses, and businesses will be able to come to the marketplace and they'll be able to at least borrow. One more thing I think that the regulators will need to do is to improve their own, to change their own thinking, number one. And number two, we have seen regimes where there is an apex regulator and there are exchanges. I think we need more intermediaries. We need to create more associations because regulators' job is primarily enforcement and supervision. It's a very fine balance that the regulators have to keep between development and supervision. So that's the role which needs to be passed on to the association of mutual funds or capital market brokers or whatever. I think we will see a lot more of those. So I'm seeing going forward more of these associations. I think the shape of the stock exchanges will change. I think the financial inclusion and the financial awareness will become very, very important. And documentation overall in the economy will play a very major role in being able to provide financings to the next generation companies.
I heard a number of different themes over here, some consistent, some inconsistent. I started the session by talking about some of the, let's call it complaints, if you want to call it, about what the finance. There were also a number of positive things that were said, as you would expect when people are partners and important. And some of the themes that came up were that, you know, through our process of engagement with a PE firm, we actually understood the journey. They taught us the importance of operational excellence and a strategic mindset. In our conversations with the public sector bank that has served our family for 30 years, we learned that the journey forward requires a number of changes. So please take the comments that I made in terms of as mostly intended to provoke these gentlemen. They were not provoked. That's why I guess why they're bankers. But one of the things we are doing, my firm, the Boston Consulting Group, in partnership with the Forum, is conducting a survey of GGCs, which is quite in-depth, and it's meant to cover a few things in terms of financial services demand, your needs, whether you're satisfied with what you have today, and what you would like to see from your financial services, which I'm sure these gentlemen would all find extremely useful. That survey is out and available, and Please let me know or let one of the organizers know if you would like to have a copy. It would be extremely useful and rich input. But I'll turn back to, and Ashish, maybe we should count you out, because if you feel it's not an opportunity for you, but you have a broad experience across global institutions. But one of the things I'd like to pose to you is, in terms of your dealings, most of you feel it's an opportunity, but in terms of your dealings with the kinds of companies you want to find, fund, and support, what are some of the obstacles you see? And you brought up the issue of documentation. What are some of the obstacles you see in terms of being able to actually have meaningful dialogue that ultimately ends in a meaningful relationship? Maybe I start with you, and then we can go around there.
Look, I mean, in terms of...
He's a top investment banker. It's not a suitable question for him.
No, not at all. I think some of the best business models in investment banking have been getting some of these companies at a nascent stage, at an early VC stage, finding, whether it's a VC partner for them, working with them from a strategic perspective, from an operational perspective, guiding them through the different stages, going from VC to PE, finally to an exit on an exchange. So, and there have been plenty of these stories. I think the issues we are going to find going forward, and I'll speak, from a global perspective, clearly some of this is going to be the capital standards, the risk.
If we could focus a lot more, not on your internal issues, but what you would like to see from the companies. What can they do
certainly.
to...
So from a company perspective, I think a lot of this is going to pick, I think the company will have to get people comfortable, one, with their business plan in terms of their operating model, the viability of that business plan. I think in some of these new generation companies or some of these startups, usually there's also key man risk. And what does that mean? And how do you get over it? And, and getting the risk people on the financing side comfortable with that. And then the last point will also be, I think if it's nascent and it's, early stage really doesn't matter, but valuation, and over time, that perception of valuation and how that plays out. Because I think, every promoter will think his company's valued far better than what you're willing to come back to it. So that's how I see it play out, is much more of them explaining that business model and how do you get over some of this key man risk, because very often it's you're lending on the back of that one person.
Maybe we continue the equity theme before we broaden it out to the universal commercial banks. Manish, from your perspective, what is it that would make it easier for you to work with companies?
We've been in this field for a relatively long time, last 10 years or so, making a ton of investments. But to what Ashish was saying earlier, and what I had said in the opening remarks, the biggest issue we see is around valuations. Valuations, and then from the perspective of the company, and from the perspective of the private equity player, it's about exits. And the reason we formed, and historically what we had done, was to take small minority positions in emerging companies. I think the way the market has developed, and given the plethora of players, private equity players, where there's actually now in most markets there is a discount that private companies have in terms of the valuations. In India, the last 3-4 years actually saw, surprisingly, a private equity premium, where the PE players are falling over each other to fund companies, many of them around this room, and lost all track of valuations, where led to a situation of disillusionment of the industry by the LPs who were the eventual funders of this. And I think what we're seeing now is a significant consolidation in the PE industry itself. So our model is significantly different, where if it's an area on valuation, we just don't get involved. We have to have, to answer your question specifically, the companies we try to help are those, and I say help in an older, more McKinsey-ish consulting format, where it's not about just the capital we deploy. It's much more around understanding what the company needs to become a much stronger player in their respective industries, and what we can do to align ourselves behind that. Now, that all sounds cliched and everyone says the same thing, but very specifically, I really believe the companies you're talking about, whether these are high growth emerging companies, one of the critical things lacking in India is, especially amongst the family entrepreneurs, which have done a great job in launching through enthusiasm, is a degree of professional managers, or being able to attract a very high quality, high caliber level of professional management talent. What we've done in our model is taken guys on who've been professional managers all their lives. People like Pramod Bhasin, who might be in this room, Sanjeev Aga, people like Vendi Banga, who've joined us in our effort to essentially, if needed, definitely join the boards, but provide a much higher degree of comfort to the companies we invest behind, such that it doesn't become a negotiation, hey, put one of our guys who is, and I'm shooting myself here, is a young MBA, and I consider myself young, out of any school, who may or may not be able to add value because the term sheet says so. But it's much more around getting somebody on board who can truly add value, and we tend to separate the investment decision from the operating decision. There's a fundamental tension in the industry, in the PE industry, vis-a-vis our portfolio companies. And we aim to overcome that where valuation does not become the challenge, but the reason companies invite us on is not just the capital, which I think is a commodity today, but it's much more around what other value do your operating partners, which are not the investment team, deploy the company. Because these companies are the ones which I think, to your earlier words, it's the enforcers of today which will become, it's the startups of today which will become the enforcers of tomorrow. But again, I see these as startups, as entrepreneurs, but I also see a need for this amongst the multi-business conglomerates. I see some of the challenges facing even the largest business houses in this country are they're significantly over-leveraged, significantly in many more areas of business than they need to be. And I see a degree of consolidation happening there too, where I see these large conglomerates spinning out many of these companies, which also will attract many, many entrepreneurs like yourselves. But it doesn't need to be a startup. You could be taking on a platform which has some positive revenue and growing on that.
If I pick up on that, Manish, it's you and some of the points you made around, it's about having a plan that can translate into certain cash flows and thinking about valuation that's based on a projection, a financial plan, a business plan that is backed up by operational capability and managerial capability, as well as some commitment to change from what may be a typical family business to one that is more professionally run, whether or not the family member is in controlling possession or not. So if you just build on some of those themes, Mr. Chaudhuri, given that you have really, what you serve extends well beyond the equity space, there's the debt, there's all the transaction banking. So you're able to serve a much wider range of needs. What would you like to see in terms of these companies that would make them more attractive and make it easier for you to serve them?
I think the industrial landscape has changed, and when we started supporting the smaller companies without capital, the amount was 2 lakh rupees, and the concept was called an entrepreneur scheme. Entrepreneur need not bring in capital. Entrepreneur need not bring in any capital, but those days are over. I think there is greater success in the non-conventional kind of industry. So basically what we think is that the entrepreneur has to sit and decide what kind of business is this. Is it a high risk, high reward business? Then go for equity. But if it is more commodity and steady cash flow business, then it's possibly preferable to go for debt. But most of the time, people go for the kind of funding that is easily available. But that may not be the most optimum thing to do. And the entrepreneurs who are really small in terms of capital and do not need as much capital, so we have a scheme where up to 1 crore of rupees, any debt can be given without any collateral from the entrepreneur. So it is just if the physical assets are not very heavy, they are within 1 crore. So that scheme is particularly useful. But for that, I think to step into that, the basic thing an entrepreneur, in order to become acceptable to the bank, would be well advised to undergo a credit rating. Now, many people would come across with this, what does this rating understand? But no, it is like a doctor's health checkup. Even if you are young, having good health, it is always good to do a checkup. And what it does in terms of, opening doors, even if you have a decent rating, so opening doors, you go in, so credit rating is extremely useful. And I would say that, sometimes, because as you mentioned that the branches, as Mr. Kapoor mentioned, branches, but please remember, the branches of SBI are 14,000. Each branch manager differs from the other in terms of their energy and, the spirit. So sometimes you may be lucky to get a good branch manager in an X bank, but do not stick with the same bank unless you think this bank can serve your long-term purpose. And we have seen many companies, when in the early years they are helped by a particularly proactive branch manager, but then as you grow, you may find that bank is not good enough. So do not get stuck with this kind of emotional feelings, which possibly people in this part of the world, India and Pakistan, that I started with this bank, I must continue with this bank. So please have an open mind on this. And secondly, I think you need not own everything. Try all the pay and use models. For example, in floriculture, there are centralized facilities for storing, there are centralized facilities for refrigeration. So to the extent you can use that, that is extremely useful. Even in heavy machining, there are places where there is centralized facilities being done. So you have to look at all the options. To summarize, you sit down and take a deep breath and say what my business is. Is it high risk, high reward? I go for equity. Spend time with the private equity. It could be frustrating initially, but that's the way to go. Then the debt. And then, as I said, if your fixed capital is below 1 crore, I think any bank would be very happy to fund. But as Ashish said, the banks also have pressure on capital. Now you have to become acceptable and desirable to the bank. So go for a credit rating. So I will limit my comments there.
I think just, I know that Ashish has certain negative views of credit rating agencies. But I think the point you made is it's not just the rating, the fact that you have gone through the preparation and the process of making yourself ready, so you have documentation, cash flows, etc., is probably at least as important as the credit rating itself. But we'll give you an opportunity to respond to that.
Sure, yeah. I mean, rather than responding on the credit rating part of it, for me, when you ask an entrepreneur, what is stopping you from listing? And it varies. I think the largest issue is we are not aware how to list. And only large companies can list. So that is one part of it. Second is why bother? I mean, you get one more regulator. Anyway, in India, you have so many inspectors coming and touching you. Why have one more regulator? And so that's one more worry. Third part is when you go to a private equity or even a venture capitalist, it's the other way around, saying, if you are below $20 million, ticket size, don't come to me. I mean, my costs don't allow me to go below. And so that's sort of what I call positive on the listing part of it. The other part is that people worry is the discipline. That once you list, you end up being disciplined. You are forced to be disciplined, come out with quarterly results or half-yearly results, answer the investors who are not in your family, and you are not used to answering, even if your business is going on for 100 years. You are not used to answering. Now you have to answer a small guy, 100 shares, and why would you do that? And those kind of issues, once you train them, once they've kind of seen their friends, and there are role models who kind of now are coming up, it becomes much easier for them to accept that, okay, this is also, sort of you can handle it well. It's not something very wrong. And then I keep on asking, everyone, I mean, all our stories in India started small. Whether, I mean, Infosys, I mentioned about even Dhirubhai, when he came back from Eden, what did he start with, He started selling spices. Okay. And then he listed Reliance, and then you know the story. But the fact is, every time, if you had listed at early stage, you would have, I mean, the entrepreneur would have benchmarked himself much faster with the rest of the world. He would have got even his wealth increase happening much faster and also become more professionalized much faster than what it would generally happen now. So those are, for me, I mean, if you can do a nice little thing in credit rating and all, why not? But if somebody wants to even land on that basis, why not?
Mr. Kapoor, your views, how do you think people can be ready for working with you?
What's the question?
How can people be ready for working with you, make it easier for you to serve them?
Like I said earlier, the first part is that, the models in banking and finance have to navigate with changing circumstances. So Chaudhuri said the same thing as the leader of the industry, that we have to manage, first and foremost, that bankers today, at whatever level, small, medium, large, have to become more and more diagnostic and prescriptive, and I'm reiterating this point. The second point I really want to emphasize is that bankers, financiers, really need to understand life cycle banking. That's my second, key point. That life cycle banking involves not just, the working capital and the term loans, but the ability of the banker, the relationship manager, to be able to create a touch point with the relationship and determine when is it a good time to recommend to the promoter and the owner to go for a capital raise and, private equity and otherwise. So bankers today, in the second stage, as they mature in the life cycle of banking, from being money doctors, they have to get into life cycle banking. After that, the wholesale banking elements start, then it's free for all. So my simple points are that see growth opportunities, make a determination of where can you really concentrate and make a big difference. And I think life cycle banking is a phenomena not understood in Indian banking. Public and private, we are basically the same sides of the coin, So, so my judgment tells me that we have to, create models that understand that how we are going to create at every, like a product life cycle. If you see a product, when you go through the life cycle, at every touch point in the product life cycle, you have a need. So how to fulfill the need? Every relationship needs to be plotted to make sure that wherever in growth or maturity or at the early stages, you're able to create a credit product or a service product or be able to understand and visualize and actualize what the client needs. So from client relationship management models, what I'm advocating in my own bank is client managed relationships. CMR, not CRM. Because people need to fathom, my boys and girls need to fathom in my bank that today the client needs have to be made into a prescription. You diagnose it, you prescribe, and that's the new banker in India, that's the new knowledge banker around the world. Universal banking, this phenomena about lending across the board is historical. It's like, in the history books. So we have to create ideas. Private equity is, in India, is once in a while. Please remember in India, promoters in India want private equity in a slightly different model. They want private equity investors to be their co-partners. Stay with us, but don't tell us what to do. So the entrepreneurship of India has to be facilitated by iBanks. I used to be an investment banker a long time ago. But, private equity players, new and old, in whatever form they come back, that they have to understand that promoters want ownership. And this model about old houses rediscovering themselves, I personally believe is not really that easy. Because old houses, old family conglomerates, unless they produce brilliant leadership, like Rahul Bajaj has produced 2 brilliant sons to manage 2 different verticals, those are like phenomenal succession plans. But, most of the traditional owners in India are very different. 70% of India in the last 20 years, post 1991, are new owners. 70% of market cap in India are new owners, right? So it is going to be India's story in the future, like Mr. Chaudhuri implied, is going to be new owners. So you need venture capital. You need banks to run knowledge cafes to give them advice. You need rating agencies, like he said so articulately, to be able to advise them that where are you on the sweet spot, right or wrong, and be able to add significant value in terms of the going forward model. Because I've seen, when I invited private equity to my bank 8-9 years ago, they made a bloody killing. Did they add value? I would say zero. Zero. Because there's no entrepreneurship there. It was just easy money picked up in the United States of America and brought to India and made like multiples on my bank, and 15 times and 30 times, and my strategic partner made 40 times. But that issue aside, that the true spirit is that the boys and girls who are gave ownership to, that's another very important point I want to make. Today's model requires that the boys and girls who come to work for you, give them ownership. For heaven's sake, give them ownership. Because that builds the tenacity, the weatherproofing of an organization, that I would love to see new enterprises, even somewhat dated enterprises. Old enterprises have overhangs, so they'll never do it. But the new enterprises of the nation have to create a stimulus for the new boys and girls to become co-owners. When I started Yes Bank, and because everybody is talking about their own organizations, I gave 7.5% to my people in the bank. They become very rich through very turbulent cycles in the last 4 years. I've not sold a single share, but some people have bought fancy homes in my office. The point I'm trying to make, you must make them owner-manager partners. Because the ownership of an institution, beyond an individual, beyond a family, is the institutionalization of an organization, is the character and the discipline of an organization, is the endurance and sustainability of the organization. So ownership, I got divine opportunity to build my bank single-handedly, right? But I institutionalized that. So today I know, even if I'm here, it's going to be well managed. I know I'm going to be very busy next 30 days for my first daughter's wedding, right? But I know it's going to be well managed. It's the institutionalization. So I encourage entrepreneurs in this room and through communication on this program to really institutionalize, create channels, and be able to share and build this mentality.
Understand, yeah.
Far beyond the Marwadian mentality of being owner-manager partners in India.
Actually, it's wonderful how you went from talking about yourself as a bank to yourself being your own growth experience, and the funding and support you received, potentially lack thereof. Before we get some short remarks from you, I'd like it'd be great to get some questions, your views especially from the growth companies. So if you could just hold that thought for a second, I'll give you and others a couple of minutes to compose yourselves. If we could get just a quick observation from you about what you already talked about a lot of things. Is there anything you'd like to add to what has been said in terms of the preparedness of companies themselves to be able to take advice in funding?
I think a lot has been said on the preparedness of the companies, but one point which I would like to make is I think banks will probably not be able to meet the needs that we are discussing here. Because banks are in the business of lending money, and the depositors have given them this money to be invested in very safe sort of instruments. So the profile of the depositor is very different than the profile of the investor in the private equity. I think banks, the core business is lending. When we talk about risk capital, percentages and the absolute amount both come into play. People generally would not invest the first 50, 60, 70% of their savings into high-risk capital. Only beyond that, the money will go into that. So that need has to be met by private equity or venture capital investors. That's the one point on which I have a slight disagreement with Kapoor Sahab on that. Now, on the private equity, the reality is in India and in the rest of the world, a lot of businesses are not able to raise money because private equity guys, they are very busy and the industry is a bit fragmented. what is an ideal scenario? An ideal scenario is any entrepreneur who has the right business idea should be able to raise money. Simple. And how can we achieve that? We can achieve that only if the private equity business itself is consolidated, and that can happen through the marketplace that I said, because the private equity investors, they also need to see price discovery, number one. The valuations have to come out in the open, and liquidity has to be there. At the moment, when a private equity investor has invested in an investment, they have to remain with that investment. It's very difficult to get rid of that investment because there is no marketplace and there is no price discovery. So I think that's one thing which which the regulators and the industry will have to work on going forward. Another thing, I think another space where there is a possibility of providing access to finance to the new businesses is the microfinance institutions that I think are evolving. They're evolving primarily in the NGO sector or not-for-profit organization, et cetera, et cetera. I think that's an area which needs to be regulated, and that can provide financing to businesses in the rural areas, especially India and Pakistan, where there's a large percentage of population residing in the rural areas. So that's another opportunity which exists. And those will be very, very small kind of businesses. But I think that's an area I just wanted to touch upon. But the primary point which I want to get across is that the PE and the VC industry will need a consolidation so that it comes out in the open and everybody has access to it.
Okay. Thank you. So we had a question over here. As you ask your questions, if I could request you to just introduce yourselves, and if there's a particular panelist you would like to answer, please name them.
I'm Rajiv Mantri. I run a venture capital firm in India. I have a question for Mr. Kejriwal. Two-pronged. So why don't
can we keep the questions short as well?
So why don't we see more domestic institutional capital coming from India, whether it's from financial institutions or from high net worth families? And secondly, from a policy perspective, what can the government do to address this issue?
Want me to take it now? Firstly, call me Manish. It sounds like talking to my dad, yeah? Listen, what we try to do with our fund and is actually try to raise some private domestic capital, even though, as Rana says, it's so easy and cheap to get cheap American money. We are trying to get some, it's not that easy. I need to have a conversation with him after this thing and maybe get his guidance how he finds it so easy. But we will do that offline. But the issues actually around is, I think you will see a change. If you look at China and see the amount of domestic institutional capital that there is, it's amazing. The renminbi funds today are larger than the dollar funds. But in India, we've been, and again, it's too easy to blame everything on the government. It's not the government's fault. But if you look at the whole insurance industry, it's just evolving. The whole private, besides LIC, which is a mammoth giant, which has always funded private equity as an LP for years, the private capital, and I think insurance, especially life insurance, is best placed because it's good matching in terms of duration. They couldn't because of a regulatory issue, which IRD has just corrected. So today they actually can, but I think they haven't, and I think it's a great asset class for them to deploy capital behind. But they need to understand it, experience it over one cycle, because as you know, there are pros and cons. This thing could be, it could be good, it could be a disaster. And they need to be sort of aware of that one. So in my mind, it's an idea whose time has come, but the real volumes of it will happen, but it's a couple of years away. And I would just look to China in terms of their own domestic financial institutions to see what they have done to get it. And I think the government gets it. It's just not a priority. And maybe people think like Rana that it's just so much easier to get foreign capital. They don't spend time spending capital domestically.
Can I just add to that? I think in China, I think it's also, the government completely understands the need for capital, and especially to fund the SMEs. So they've started some public-private partnerships in that area where they've started like credit funds and stuff, where the government guarantees or at least gives you some sort of credit protection or gives the banks credit protections against loans made into that area.
Yeah. Or OPEC.
And some more questions, I believe. And hopefully we get more questions from companies and corporations and not necessarily just about the...
I'm not from a company, I'm from the media. But the question is, there is a recent report by Justice Sri Krishna who recommended a super regulator. So will banks in India be more comfortable with a super regulator?
I would request if we keep it on on theme rather than broad questions of regulation.
I thought because there are banks.
No, thank you very much. Let's pass the question to somebody else. I hope you don't mind my exercising.
I'm Anshuman from the Week magazine. My question is to Mr. Chaudhuri, that don't you think that, sir, that there should be a line between financing the growth and or financing the aspiration or say inspiration or need of a particular company or a person so much so that he turns defaulter and it becomes NPO for a bank, especially in a scenario where, people start accusing you as, just financing only the defaulters.
That is precisely the issue because, any company, any bank which is very high on financing the aspirations, empirically suggests ends up with getting large number of defaulters. So that is precisely the challenge. The banks have to keep in mind that on one hand you are financing aspirations, but other hand you also have to keep your book clean. So that's the fine line, and as I said, for doing that, there are, and as Ashish said, just as in China, even in India there is a scheme for financing assets up to 1 crore where we are pretty liberal because there is a government guarantee coming in. Does that answer your question adequately?
I was looking at talking in the sense of bigger corporates, the NPA is turning out NPAs. My question is in that sense, like bigger corporates defaulting in recently things.
Yeah, bigger corporates defaulting is a function of, I think, largely the economic growth scenario. So when you have a high growth, 8 to 10% growth, everybody makes optimistic projections and crashes in the lead time, including, say, the repayment period for this hotel we are sitting in. In good times, the hotel owner would say, why should I, look for 15 years, but look for 8 years or 9 years to repay. See, these are the room rentals, these are this, and I think they would be corroborated by their equity partners. But when the cycle, becomes much less robust, so then we find that possibly it would have been better if we had gone in for a 12-year or a 15-year. And unfortunately, in India, the regulations that are there, that if you take a 8-year loan but paid back in 10 years, you have a problem. But if you, the same loan, if it was structured as a 14-year loan, but paid back early in 10 years, that is never resolved.
Any further? Please.
I'm Manoj from Chaudhuri Global. This comes from a perspective of a growth company. Now, what happens in a situation where, because of the challenges of the economic situation, a company goes through a difficult phase, what happens to the financing? The experience generally has been with the banks that they look for today hard assets, preferably in India, real estate in prime locations. When you ask them for financing, does the promoter have a house in this area, that area? No, we have agricultural land in Africa. Oh, that we can't do much with. What happens with that? That is hard asset you have invested in. So, those kind of situations, how do banks look at that?
I think it's a great question because Mr. Agarwal's firm is the biggest producer of roses in the world. So how would you think about this kind of company, which is clearly very successful but doesn't have the standard collateral that you may look for?
Would you give him the hand mic?
Blamed for monopolizing this thing. See, all over the world, the regulators are into this, that you first finance the assets in my country. Don't go about. So, the India's regulator would say, well, he runs a good rose business in Africa. Why doesn't he get funded from Africa? Why should my funds, for which I am giving a depositor guarantee, be used for financing the assets in Africa? It may so happen that the owner of that farm or business is an Indian, but the next question would be what stops him from selling off the business tomorrow? So this kind of what I would call maybe regulatory nationalism is coming in everywhere. And the regulators are saying the first, whatever funds you raise in my jurisdiction, use it for financing assets and jobs in my country. I'm not too interested what you are doing overseas. So that's the way I think the situation is going to be for the foreseeable future.
our bank can't certainly do it, but I'm sure there are other banks that would, which have branches in Africa that, where you could give that land as collateral against an LC that bank could probably write to the branch in India and basically get your financing in India, if that's the way you look at it. But they probably will, obviously you've got to go through legality of getting the collateral in Africa.
What can you do as what can you do to help business, them?
I'll just add, Ranu, that because this is a horticulture and floriculture business, which has got its expertise in India, and it's got bastions, it's got platforms in Ethiopia and other parts of Africa. You know, it's like you have to build a financial model which is distinctive. The best part of building, and it's a very good model, it's an outstanding model, you have to go to the African Development Bank. The African Development Bank and branches of State Bank of India and Bank of Baroda in those locations are the ones that you have to go to build a freestanding and independent model. You can't have Indian banks sitting in India understanding the risks of execution and otherwise in the geography which is beyond India's capacity. So when you globalize a bank, as State Bank of India and one or two other banks have done, you have to take the risk local. The third point I want to make quickly, that the world has seen, as Mr. Chaudhuri said, a compartmentalization of home country banking and host country banking. I've chosen a model to concentrate only on home country model banking. So home country banking is a different model from banks that were globalized, and you realize that public money is going into different parts of the world and sinking their ships. So the new order of banking in the world has changed very dramatically from home country, host country, into very limited scope global banking. This is a new phenomenon in banking that's evolving, and please observe this and build your banking relationships accordingly. As far as I'm concerned, I'm only home country banking.
No, but you can give a guarantee and we can finance. Supposing you understand, it may not meant as a joke, because if you think you have strengths in India, please be willing to leverage those strengths. So therefore, what we could think of is that in that African country, if there is already an Indian bank, it is much easier. But today, to finance an asset in Ghana, you need not be in Ghana. You can do it out of London. Or to finance an asset in Indonesia, you can do it out of Singapore. So banks in India, in fact, Reserve Bank allows up to 4 times your net worth, you can give guarantees. So if you are willing to do what is called with recourse financing, you tell the banker, don't worry about the rose business in Africa. If it works to my advantage. If it doesn't, you would be safe. So you can catch on to me. So that, I think, inspires much greater confidence. So your banker here, whosoever it is, if it gives a guarantee, I think it would be easier to find a bank which can lend for the activity there. Yes.
Yeah, if I could just add, I completely agree. I was just about to say the same thing, I think you've built a superb model. And I think it's kudos to people like you and entrepreneurs like you to expand that from our shores across the world. Right? And I really think it's guys like you who will come out ahead. And banking, especially debt and equity, is becoming more commoditized. So if there's a good idea, it will be funded, irrespective of where you put it. Now, you can give a guarantee here, or you can get someone with a higher risk appetite and charge slightly more money. But at a certain rate of interest, you will get money. And in case you don't, which some people do overextend themselves, it's on the debt side, you've got to just strengthen your balance sheet. Right? And it doesn't need to be private equity. It can be local markets, it can be development financing, it could be local listing it in local bourses.
I think we have time for one brief question and one brief response before we try and wrap up.
Hi, I'm Amit Mehta from the LNB Group. Yesterday, as Ranu said, we did have a discussion on a forum on the closing financial gaps for growth companies. Unfortunately, there was not much representation from the banking sector, and it ended up as being a convenient place to bash the banks and say that, banks are not responsive to our needs. I would just like to ask one thing and not make it that convenient for the corporate side, is we generalize saying that banks are getting a tick-the-box type of model of funding, and they are not, the form over substance is prevailing, and they are not getting the true essence of what the project is about. As a banker, what is it that you can tell us, what is it that you're looking for from the corporate side? What should companies do more important to be able to, when they come up with a project, they can explain you better, and if there are practical problems which you can't, though you appreciate on the face of it, but while sanctioning a loan, maybe you cannot do it. So if that's something the companies can do, we would be happy to hear from the banks.
Well,
I think firstly we would like to see the entrepreneur's skin in the game. That if this is 100, we need the entrepreneur to putting in 25, 30. And secondly, as I said, high risk, high reward, we'd like the entrepreneur to put in. And of course, for a commoditized business, we would be happy with a lower equity. And secondly, entrepreneur's equity does not mean your personal equity. So if you are not able to put together, now it's happening, say, even in airlines business, no Indian company is able to put together the kind of equity it requires. So it requires equity from outside. So look for expanding the equity base in, even if it is necessary or it may be required to, share the ownership. But nobody can predict the future, so therefore the cause on the future is some amount of guess. And just to be giving in the banker's perspective, supposing I say, I took a bet on this company and I thought it was a great idea, it didn't work. If I go and tell the depositors that, sorry, I took a bet, I took your money and betted on this idea, it didn't work. So, instead of collecting 9% interest, you collect 6% interest. You would not agree. So we are under an obligation to give a fixed return. So therefore, our ability to take little unconventional risk is less, and that we expect to be funded by equities. And even in US, I would think that the software business has been funded more by private equity than by commercial.
Thank you so much. What I'd like to do is actually go around the group, and if in 15 to 20 seconds or less, you can say, what is it that you took away from this session? What are some key points that you feel are important in this context? I'll start with you, Mr. Mohammed Ali.
I think a very clear message is that, again, what we discussed in one of the sessions yesterday, that coordination between various participants within the system, I think that is what is needed to achieve the various things that have been highlighted here. The number of issues which have been highlighted, and today's reality is that in order to meet the needs of future generation companies, be it on the debt side or equity side, there will be a lot of coordination which will probably evolve and happen in the future, be it between the regulators, market participants, intermediaries. I think that will happen. And another thing which I think is important, which is coming out of this, is that the banking sector will have to probably play a much more powerful role in the future as far as the financing needs of the companies are concerned.
Let's continue this way for a change.
Yeah, so for me, the perspective is that the need of newer businesses is very different from what I call traditional banking model and even traditional PE frameworks and so on and so forth. So we need to be, it's a kind of an evolving thing on both sides. Regulations are evolving and risk management is evolving. So for me, it's a sort of a very interesting conundrum where we are trying to find answers where the goalpost is changing all the time. And for that, I just wanted to inform that we work with angel groups of Indian origin, on also foreign origin, venture capitals, even Indus entrepreneurs and so on and so forth. The cost of listing has been brought down. Even on valuation, you were saying there is an issue. What we have done is very interesting, saying we force you to give up only 25%. So even if you think your company is much more valued, 75% remains with you. So later on, you will be much richer, right? But list it now. And so in some sense,
price discovery without.
And for me, this is like negotiating in real time this entire evolution which is happening in front of our eyes. And this model is not going to stay stable. It's going to run pretty fast, pretty quick before any one of us realizes.
Great. Rana?
Basically, I go back to my points. One, banks, institutions, whichever part of the world, I think this is a global phenomena, global crisis, European crisis, Indian crisis, everything included. One, have to be very diagnostic, very prescriptive, and I repeat this point about being money doctors. The second point I repeat, which is that you must be able to analyze and involve a company through relationship management and whatever tactics you have to build a model on life cycle banking. I find even in the biggest banks, including State Bank of India, that connecting all the plumbing pipes in a system is very important. How to connect the horizontals. So you must build good life cycle banking model, number 2. Number 3, easiest but most difficult to get done. Monitor it through very good MIS systems, just like a good doctor monitors. When you come out of intensive care, monitoring is very important. That means being proactive on risk and being proactive on relationship management and seeing the growth in terms of deepening relationships in the right end and responding to them before they become problems or before somebody else hijacks your account and UBS says, okay, I want to do your IPO. You say, oh, I want to do your IPO. So that's also very important.
Manish?
The one thing I took away from this discussion more broadly was the power of entrepreneurship. You know, we've always had providers of capital and users of capital. I think the weight has truly moved to the users of capital, whereas the providers of capital, all of us around this round thing, frankly, are more commodity-like than we were 10 years ago, especially in a country like India, which is seeing various forms of capital, be it debt or equity. And I think the beauty about this country is our level of entrepreneurship. I think around this room, around this table, it's in our blood, it comes out that way. And all I think at a very generic level going forward, what it needs is a much better partnership between the providers of capital and the users of capital such that it's value additive and one is not free riding on the other. And partly in jest, but I truly mean it sincerely, also is, you know, I look at Rana and I say, he just happens to be a banker. What he is before that is an entrepreneur.
Mm-hmm. All right.
What I would say is that, you know, I think India, to some extent, largely, and the growth in India has been driven by private entrepreneurs. And there is an acute shortage of capital, and there will be an acute shortage of capital going forward due to a whole host of reasons, some of them macro. I think it's incumbent upon our government and also working with the private sector to overcome some of that acuteness. And I think it also, and for international banks like us, it is how do we attract capital from rich saving countries, rich high-rate saving countries into India so it can be put to good use here. Obviously, it all is commensurate with the risk-return reward framework too.
I think in India, particularly since the rate of interest are very high, so relatively entrepreneurs, in order to make their businesses attractive, would have to look to generating higher ROE. And I think in some ways we are drawing boundaries around ourselves. That we are saying, well, I can't go beyond this. An entrepreneur says, this is the max I can do and I can't come beyond this. So we have to think of how to expand these boundaries. Some boundary expansion has to be done by banks, some boundary expansion has to be done by entrepreneurs, but it's very important that we do. And some of these measures, like what are called credit mitigating measures, to the extent they come in, they are very useful. And for the entrepreneur, just for your health checkup, submit yourself to an independent scrutiny. That will bring out many truths which you yourselves may not have been aware. So whether you want to accept them, reject them, partly accept them, entirely up to you. But subject yourself to an independent scrutiny.
Thank you. I wanted to thank the panelists for their contributions and all of you for being keen and interested and contributing to the discussion. I think if we can end on a couple of those themes that the panelists talked about, the themes of entrepreneurship and partnership, I think there's a lot of opportunity. It's clear, and I hope for many of you who typically come across a financial institution when you actually need something from them, this was a good learning experience that actually the financial institution, which may be a formidable negotiator, actually is trying to help you. You may not always realize that in the heat of the negotiation, but clearly there is room for partnership, and there is a genuine desire to help. So thank you very much for your time. As always, there's a request, I believe, from the forum that you fill out the satisfaction surveys on your way out. Thank you very much.